In this video, we'll explore the ins and outs of midterm investments, specifically focusing on bonds. Hi everyone, welcome back to Old School Investments. Today, we're diving into the world of bonds, a key instrument in the realm of midterm investments. We'll cover what bonds are, their types, how they work, and the risks involved. Stick around until the end because we have a special bonus topic on how to maximize bond investments. Let's start with the basics. A bond is essentially a loan you give to a government or a company. In return, they agree to pay you interest periodically and return the principal amount at the end of a specified term. Imagine you purchase a bond for $10,000 with an interest rate of 3%. This means you'll receive $300 annually as interest. After 5 years, you'll get back your $10,000 along with the final interest payment. Why are bonds important? Bonds are a reliable way to earn a steady income, making them ideal for midterm investments. They are less volatile compared to stocks, providing a safer investment avenue, especially for conservative investors or those nearing retirement. There are various types of bonds. The most common are government bonds and corporate bonds. Government bonds are issued by national governments and are generally considered safer but offer lower returns. Corporate bonds, issued by companies, usually offer higher returns but come with higher risks. One popular type of bond is the plain vanilla bond. It's straightforward, you lend money and receive fixed interest payments until maturity. For example, if you buy a $10,000 bond with a 3% interest rate, you'll get $300 each year. After 5 years, you get your $10,000 back. Simple, right? But what about bonds with different characteristics? Step-up bonds are an interesting variant. They start with a lower interest rate, which increases over time. However, they can be tricky for small investors. For instance, a bond might start with a 2% interest rate and gradually step up to 4%. While this might seem attractive, the initial lower payments mean you miss out on potential earnings early on. Zero-coupon bonds are another type. They don't pay periodic interest. Instead, they're sold at a discount and mature at face value. For example, you might buy a zero-coupon bond for $900, and after 5 years, it matures at $1,000. The difference is your earnings. These are great if you don't need regular income but want a lump sum at maturity. Let's talk about risks. The primary risk with bonds is that the issuer might default. If a company or government can't pay back its debt, you could lose your investment. To gauge this risk, look at the bond's rating. These ratings, ranging from AAA, very safe, to D, in default, give you an idea of the issuer's creditworthiness. Another risk is interest rate fluctuations. If market interest rates rise, the value of existing bonds falls. For instance, if new bonds offer 4% interest and your bond offers only 3%, it becomes less attractive, and its market price drops. Conversely, if interest rates fall, the value of your bond increases. Now, let's get practical. Suppose you buy a bond today, on September 7, 2023, for $10,000 with a 3% interest rate. You'll receive $300 annually until September 7, 2028. On that date, you'll get your final $300 interest payment plus the $10,000 principal. This is a straightforward example of how bonds work. However, bonds can have more complex features. Some bonds have call options, allowing the issuer to repay the bond before maturity. This usually happens when interest rates drop, and the issuer can refinance at a lower cost. For example, if you own a bond with a 7% interest rate and market rates fall to 3%, the issuer might call the bond to save money on interest payments. Convertible bonds are another variant. These can be converted into a predetermined number of the issuer's shares. While they offer the potential for higher returns if the company's stock performs well, they also carry higher risk. Before we move on to our bonus topic, please take a moment to hit the like button and subscribe to our channel for more insightful videos on finance and investments. Now for the bonus topic, maximizing bond investments. One effective strategy is laddering. This involves buying bonds with different maturities. For example, you might buy bonds that mature in 2, 4, 6, and 8 years. This way, you reduce the risk of interest rate fluctuations and ensure a steady stream of income as each bond matures at different times. Another tip is to focus on tax-advantaged bonds. In the U.S., municipal bonds often offer tax-free interest income, making them highly attractive for investors in higher tax brackets. Always consider the tax implications of your investments to maximize your returns. Lastly, stay informed about market trends and economic indicators. Interest rates, inflation, and economic growth can all impact bond prices and yields. By staying informed, you can make more strategic decisions about when to buy or sell your bonds. And that's a wrap. We hope you found this video on bonds informative and helpful. Don't forget to leave your comments and questions below. See you next time on Old School Investments.